I'm going to show you a trick that takes 5 seconds to understand, but it will save you from many fake out trades. See, most traders look at price action and they think they see the market. They aren't. They're looking at the surface of the ocean. I'm going to teach you a 5-second trick, literally one glance, that acts as an instant lie detector for the market, which is going to allow you to see underneath the surface, to really see and know what's going on. If you master this, you will stop chasing fake moves and you'll only enter when the smart money, whatever you want to call it, has actually given its approval. See, institutions, banks, hedge funds, whatever, the people actually moving this market, they aren't just looking at EURUSD, for instance. They're looking at something far more important. They're looking at the bond market. Let's get practical immediately. I don't want to bore you with any theory here. On TradingView, just type US 10-year yield, and it's the first result that comes up. United States 10-year government bond yields. This is the 10-year yield for the United States. Now, why do we care about this boring looking line graph? Because this chart represents the smart money sentiment. It represents the true sentiment of what you would call, smart money. The people that actually know what they're doing. This price is a combination of growth expectations and interest rate expectation. Now, I've done a full video explaining how this works, which I'm sure you all watched while taking diligent notes. So for this specific video, I'm going to show you just the framework. We only need to know one simple rule. Yields show the true intent behind the market. To make it even shorter, yields show intent behind the market. If yields go up, the market thinks the central bank is going to be hawkish. They think the economy is hot, rates are going to stay high or going higher, and so on and so forth. If yields go down, the market thinks the central bank is going to be dovish. So the rates are going to go lower, interest rates, they're going to cut rates, inflation is going down, growth is actually slowing, maybe there is a recession, whatever. Growth slowing, interest rates down. Now keep this in mind because it's the key to understand how to use this. Okay, higher yields means the market is expecting a more hawkish central bank. Lower yields means the market is expecting a more dovish central bank. Basically, this makes this instrument a perfect tool for us to get an inside view into how the market is thinking about the data, about the comments, about the forward guidance, and so on and so forth. In other words, it's showing us how the smart players are reading things. Let me show you an example. CPI prints a tiny bit below consensus, actual print at 0.2, forecast was 0.3, previous was 0.3. It's a pretty boring number, okay? Just a tiny bit below consensus, tiny deviation, nothing extremely surprising. But the algorithms go nuts and the dollar overreacts to it. Look at this massive, large bullish candle on EURUSD. It shoots up. Okay. Retail sees, CPI surprised lower, well, that's dovish, dollar dumping, buy EURUSD. Now, if you look at this chart, it seems obvious, that CPI, that 0.1% miss in CPI, even though it's a very small number, doesn't really change much. Apparently for EURUSD, it matters a lot. So here's where we make the difference. We don't take EURUSD's word for it. No, we want to understand if there's real intent behind this move. So this is where we open the US 10-year yield chart, and look at that. EURUSD shoot up, yes, but yields barely moved. They stayed flat during the CPI. So what's going on here? The bond market, so the smart money we can call it, looked at the data and said, this changes nothing. The Fed won't do anything on this. So EURUSD on one side is screaming go, buy, but yields are screaming, basically saying nothing. Nah, I don't care. So who wins between the two? Well, yields win, okay? 30 minutes later, look at what happens. The move got completely faded. EURUSD went all the way back to the starting point and below. Now, if you use the reaction on EURUSD as a reason to think the CPI was actually dovish, you would have bought the breakout and you would have been trapped. Instead, if you actually waited 5 seconds to just check what yields were doing, you would have seen the real players were not playing around with it. You would have known, well, this is a fake move, I'm not gonna fall for it, okay? The smart money isn't participating, nothing changed. See, I talk to a lot of traders every day, and I've seen this mistake being made time and time again. A piece of news hits, the currency pair moves, And they use the movement on the chart on the currency pair to interpret the news. So they see the immediate reaction to the news and they dictate their views based on that. Oh, price went up, so the news must be bullish. That's not how it works, because that's exactly how you get caught in fake market reactions. So we have to go above and beyond that. You need to look at the engine behind the room, okay? So here's a new protocol. Next time you sit down to watch a news release, CPI, NFP, FOMC, whatever, have the US 10-year yield open too. Do not stare only at the currency pair, and please do not use the currency reaction to decide whether the news was bullish or bearish. You always be late that way. Look at the bond market. It's going to give you a much accurate information. If news hits and yields spike, they go up, they trend up, whatever, then you know the market is interpreting that as hawkish, positive for the economy, and so hawkish for the central bank. That's bullish for the currency. Now, instead, if they go down, then it means that the market is pricing a more dovish policy ahead. Maybe because of a slowing down economy, maybe because of softer inflation, whatever it is, you know that the market is interpreting it as dovish and so bearish for the currency. Now, here's another practical example. A slightly weak NFP prints, nothing major, but look at that big reaction in USD JPY. It makes it look like a big deal. But let's see what bonds are doing actually. Well, they're doing nothing. Again, so here the bond market is telling us the NFP is not a big deal. Definitely is not a big deal as much as USD JPY is making it out to be. Look at this. Now, in fact, notice how things start to unfold. A couple of hours later, yields start to move higher, which tends to suggest the market is starting to interpret the news as being hawkish for the central bank, and USD JPY start to bottom up and move up accordingly. Now, yields continue to march higher. Again, this is a signal that the market is digesting the news as being hawkish for the Federal Reserve. Remember, this comes from the NFP. And just like that, USD JPY has caught up and faded the whole NFP move completely plus more. See what's going on here? Currencies sometimes get distorted by whatever flow. Usually it's algos, programmed to react a certain way, but they're just very short-term algos. They're just very short-term reaction, which create volatility but don't see direction. Can be just also non-speculative activity. Can be commercial activity just using the liquidity of the news release to get some transactions done. But instead, the bond market tends to be a much more clean visual representation of how the market is fundamentally digesting a piece of data. Now, does this mean you can buy or sell a currency just because bonds said hawkish or dovish? No. What I'm showing you here in this video is how you can and should use yields to confirm whether the currency you're watching is moving with intent. Again, above the surface, price action, under the surface, yields and the macro context. Now, this won't give you necessarily a trade, because to generate a trade, it's not enough to look at the 10-year yield. There must be a lot more understandings of what's going on exactly. But this will give you a framework to avoid a lot of currency fakeouts, where currency just overreact to data that really doesn't move the needle for the central bank, but the bond market instead is showing you the truth. That's the best information you can get. And it's all about information. Trading, it's all about information. The person with the most accurate information wins. Most traders are looking at wrong price action. By lasering, focusing only on the currency, they're looking at the surface of the ocean. By watching the 10-year yield, you're looking at the currents underneath.